so today we're going to be talking about employee stock purchase plans. And I got an email a couple of weeks ago from a client, and she was asking whether or not she should participate in hers. And I think there's just a lot of confusion around how these plans work. And so what we're going to do over the next couple of minutes is talk about what an ESPP is, how they work, what the benefits of them are, and then how you should think about them in the broader context of your financial plan. So let's first start by talking about what these are. And quite simply, they're just savings plans that are established by your employer. Your employer must be a publicly traded company, but they're established by your employer where you can contribute money for the sole purpose of buying employer stock. And when thinking about how they work, I think it's easiest if we divide it up into really 4 different segments. And so the first segment is this enrollment period, and that's where you decide whether or not you're going to participate in the plan. And then you make an election on how much you're going to put into it. And you can do that sometimes as a flat dollar amount, sometimes as a percentage. It depends on your plan, but you determine how much you're going to be contributing. And that money comes right out of your paycheck. And so that is the enrollment period. The offering period is when they start to take the money out of your paycheck and they put it into an investment account that's in your name. And that money accumulates there, usually for a period of about 6 months. And at the end of that offering period, we move into what's called the purchase period. And that's where you start to buy shares of the company stock. And that's where you start to see the 2 primary benefits of an employee stock purchase plan. Now, the first benefit is that you get to choose, well, you don't get to choose, but you get to buy the stock at the lower of 2 prices. And it's going to either be the price on the first day of the offering period or the price on the last day of the offering period. And to keep it simple, let's just say that the offering period started on January 1st and ended on June 30th. And let's just say that your company stock was $90 a share on January 1st and it was $100 a share on June 30th. Well, because of the way that ESPPs work, you're going to get to buy shares at the $90 a share because it's the lower between those 2 points. Now, the second benefit is that you will receive an additional discount on that price. Sometimes it's an additional 5%, sometimes it's as much as 15%. But just to keep it simple, let's say that you get a 10% discount on the shares that you are purchasing. Now, instead of buying it at $90, they're going to discount it by 10% or $9, and you're actually going to get to buy it at $81 a share, even though right now it's worth $100. So that's where you can see the benefits to these plans. The final period is now what do? You own these shares of stock. Now what are you going to do with them? And I think it's really important before you even decide whether you're going to enroll to have a plan for what you are going to do once you have purchased these shares of stock. My recommendation generally is that you do not hold these shares of stock any longer than you have to. You are going to have to navigate some taxes because there can be certain holding requirements for whether the shares are sold at long-term capital gains or short-term capital gains. It's also important to note that the amount of the discount, no matter when you sell it, is always going to be taxed at your ordinary income tax rates. So you are going to have to navigate some taxes. But my recommendation is that you think of these as a way to generate some additional wealth. You do get that discount and the low price between those 2 points, and so you get a little bit of an incentive to save. But you use this as a way to generate additional wealth, and once you get those shares of stock, you just go ahead and you sell them. You set some money aside for taxes, work with a CPA or work with your financial planner to get a rough idea of what the taxes are going to be. You set that money aside so that you can pay the tax bill when it comes due. And then you take the proceeds and you use that money and put it towards your other financial goals, whether it's saving for retirement, whether it's saving for your kids' college education, or whether it's saving for some of your shorter term goals like a vacation every now and then. But it's really important not to just let shares of your company stock accumulate for too long, because that exposes you to 2 big risks. The first one is just your portfolio. Now you have all this money devoted to your one stock, and if that stock doesn't do well, it's going to drag on the returns of your entire portfolio. And then the second one is now you just have so much of your financial fortunes tied to your employer. When you think about it, your salary is coming from there, benefits are coming from there, and now you have all this stock in the same company that you work for. And if so that company starts to do poorly or they lay you off, it can just have an oversized impact on your financial life. And that can be avoided just by making sure that once you are able to sell those shares of stock, you do, again, you account for taxes, and then you put that money towards the other goals that you have. So that is how employee stock purchase plans work. Of course, your plan will have its own intricacies. Your personal situation will certainly be unique. And so if you have questions that you want to talk through, please reach out to any of the advisors here at Beacon Wealth Care. And thank you for watching.